Well, hey, Southern Oregon, welcome back to the Real Estate Show. Today, we're going to be talking to Guy Giles and Christy Stockbrand of Mutual Mortgage, and we're going to go over what's happening with the Federal Reserve, because that is always a thing, and it affects us here in Southern Oregon. But we're also going to talk about some of what happened in 2023 that's bleeding over into 2024. We also have ongoing conversations about what changes may come in 2024, but we're also going to talk a little bit about mortgage insurance today and debt consolidation. So lots of interesting tidbits and education coming here in just a few minutes with Guy Giles and Christy Stockbrand of Mutual Mortgage. In the meantime, let's check quickly our local statistics like we do every week. These are year-over-year numbers for the residential market. Let's start with Josephine County. Prices year-over-year in Josephine County this week were up 15%. The average single-family home in Josephine County costing $471,990. The number of sold year-over-year in Josephine County were up 25%. There were 10 residential closings on SOMLS this week in Josephine County. The number of listings in Josephine County are down 1%, which is basically neutral. There were 269 active listings in Josephine County on SOMLS this week. Jackson County prices year over year were down 19% this week. The average single family residential home in Jackson County is averaging $437,323 in the residential market this week. The number of sold year over year in Jackson County were down 17%. There were 24 residential closings on SOMLS this week. The number of listings in Jackson County were down 1%, just like Josephine County, basically neutral. We had 579 active listings in the residential market on SOMLS in Jackson County this week. Klamath Falls prices were down 16% year over year this week. The average single family residential home in Klamath Falls now costing $259,227. The number of sold year over year in Klamath Falls this week were up a whopping 175%. We had 11 residential closings on SOMLS in Klamath Falls this week. That has more to do with the time of year than anything, but it's good to see an increase, right, folks? The number of listings in Klamath Falls were down 12% year over year this week. We had 197 active listings in Klamath Falls on SOMLS this week. So basically bottoming out, getting ready to see what happens in 2024. We're hoping for a good year. And yeah, we're still short of listings. So folks, if you're thinking of putting your house on the market, now is not a bad time. You won't have much competition, and the spring season is right around the corner. You might be one of the lucky ones to grab one of those buyers from leftover from the winter, or just come onto the market and ready to look for a home like yours. So let's get ready to welcome Guy Giles and Christy Stockbrand into the studio. So Guy and Christy, thanks so much for coming on the show. Good to have you back.
Thank you.
Yeah, trying to figure out if it's winter right now or spring or what. You'll get a freezing warm day.
Sprinter. I like that.
But no, we're ready to go for the new year, and kind of excited about, a lot of the things that are going to start happening with rates. And I don't know, just looks like FHA, actually, I read an article this week that they are revisiting getting rid of the mortgage insurance after a little while on the FHA loan.
I had not heard that. Do tell. That would be a game changer.
It would be really, really nice. It's funny because they try to be so politically correct that they say it's going to be for working class people, people of color, and something else, first time homebuyers. And you just kind of shake your head and you're like, who does that leave? Maybe homeless people and people that don't work, which they're probably not getting home loans anyway. So I'm not really exactly sure who their target audience is, but if it can help our buyers, I think that's a good thing because a lot of times people, their credit score is not perfect coming out of a divorce, coming out of, just life. And FHA is the best program for them. But when you can never get rid of that mortgage insurance without, a down payment on that program.
Well, and let's talk about that for a second, because I don't know that all the listeners know what we're talking about. So first, like, what is FHA real quick? And then mortgage insurance, and why is that a big deal?
Well, what happened is after the crash, we ended up having an FHA that just wasn't solvent. Or at least they said they weren't. They didn't have enough money in their bank. So they decided to raise up the premium for an FHA loan to basically 0.85 basis points. So on a $100,000 loan, that would be about $850 a month. And you divide that by 12. Should have had that math done. That's like $70 a month. So you figure if that's a $300,000 house, that'd be about $2,100 for the mortgage insurance.
And that's to protect the bank, right?
Yeah, just to put some money in there in case people default. And to be fair, it is a little bit of a higher loan to value loan. So that's, a little bit more risk. So there's the potential for people to, potentially foreclose on that house. But it's always been kind of conventional wisdom that after you're in your house for a while, or if you pay it down a certain amount, that you would get rid of that mortgage insurance. It was just while you're in kind of a high risk area.
Mm-hmm.
And one of the things they did when they raised it up is they made it permanent for the life of the loan.
Right. And that was different because it used to be what?
Well, it used to be that it would go away. I mean, generally loans go at 78% loan to value, the mortgage insurance goes away. And
Like as soon as your house is worth more or you pay it down.
yes, yeah. So one thing they did to make it a little bit nicer is they did lower that to to 55 basis points. So that math would be about $550 a year for every 100. So that, it saved $20 a month, about $15 a month as far as that goes. And that did help, but now they're talking about at a certain point, and nobody's really rolled out what that point will be, but getting rid of that mortgage insurance, just like a traditional loan. So it's always been one of those things that, yeah, we could get you an FHA loan now and then maybe refinance you into something later. But if you can get somebody into their permanent loan the first time, then they don't have to start that amortization schedule over. There are some benefits in a lot of rate environments where you don't necessarily want to refinance them.
Mm-hmm. Well, and then there's the unknown. Those two-step processes sometimes make the difference in people getting a house or not getting a house, but it is a big question mark later.
Right.
Yeah. And so I mean, we always try to have conversations with people that, yeah, this is our goal, is to do something better for you down the road, but make sure you can live with this right now if this was the best it ever got.
Mm-hmm.
And actually doing all the math on that over the last few months, rents do catch up. I just got a guy in contract this week that his rents went up $400 in the last 2 years. And if that
What?
happening like that, yeah,
Wow.
it kept happening like that, it's not long. It would, I think, take 3.5 more years, just under 4, before he was dead even with where his mortgage was.
Mm-hmm.
And well, he's in contract now, and he'll be pulling the trigger.
Well, and he gets to keep all that appreciation. I just heard on the financial news this week that the preliminary national appreciation number for housing is 4%. This is coming out of that year. Remember this time last year, we thought the world was coming to an end and we had no idea how close to being right we were. Because we actually thought it was going to be, isn't this like last January? Weren't we talking like, oh, it's going to go to 4 or 5%? Isn't that kind of what we were thinking?
It's been
And then it went to, did it go to 8?
Yeah, it did get a little bit over 8 as far as that goes. And now the national the average right now is around mid sixes. That said, that's paying points as a general rule. So
Oh,
again,
to bring it
people
down to
haven't
the
heard
sixes?
before. Yeah, for people, and so you're looking at averages, so it's really difficult to know exactly what was priced into those loans. But we're absolutely, getting people locked in the sixes at this point. So
Hmm.
And that's where your LLPAs come into play for your finalized rate is, yeah, mid sixes might be available for some, but maybe not everybody, just depending on their situation.
yeah, and a lot of times depending on what the loan program is
Correct.
also. So we actually brought some of those to go over a little bit later if we
Oh,
haven't.
definitely.
So it's kind of interesting to find out, especially when you get a phone call and somebody's like, "Oh, I heard rates were 2%." It's like rates have always been 2%, but do you want to give me all your children, in exchange for that rate? Or, really expensive. We can give you whatever rate you want, is at the end of the day.
Well, I thought there was a limit to how much of a rate buy down you could do.
Well,
Yes, to stay as a qualified mortgage.
meaning
Yeah.
meaning that there was high cost tests that were introduced a little while back
Mhm.
that say that they don't want to overcharge you. So they are still on our rate sheet, and you can get them. It's just maybe this nobody's buying the rate down to 2%. I guess I was just trying to say that to illustrate a point that
Oh,
we
okay.
could always give you whatever point, whatever rate
So
you want.
I'm sorry, I'm so gullible. Oh my God.
Well, I mean, we could charge you a ton of money, and that's what I meant about trading in your kids for
Uh-huh.
a low rate, or, we could give you a terrible rate and give you one of our kids. I mean, it's just a matter of how long you're going to be in the loan, what you're, wanting to pay for it. So we're not big fans of charging somebody 3 percentage points to buy down their rate.
Well, welcome back to the Real Estate Show, folks. We're with Christy Stockbrand and Guy Giles of Mutual Mortgage. Thanks again for joining us on the show today, you guys.
Thank you.
During the break, we were talking more about the FHA and the interest rate dilemma, and what an interesting time last year ended up being, that the market, kind of bottomed out in that last end of the summer or so.
Yeah, I think everybody was counting on a big drop in prices last year, and it didn't end up, about halfway through the year, it ended up kind of turning around, and I think we ended up positive for the year. I think that's the number that you were referring to a little while ago, maybe.
Yeah, just the national preliminary was saying a 4% bump, and us in Southern Oregon, we're going, well, when did that happen?
No,
Yeah.
we are definitely seeing people get a little bit from the sellers that they were not getting the first half of last year. So I think they finally came around, and they're being a little bit more reasonable at this point.
Mm-hmm,
So,
mm-hmm.
and a couple of examples in the last few weeks, they're buying permanently down people's rates, and it's been a nice change since I pretty much only work with buyers.
Mm-hmm, mm-hmm. But having that flexibility in the contract for the seller to do more than what the sellers have been willing to do in the last few years, it's been all about them. It's been a seller's market. So this is the first and we wouldn't even call it a buyer's market necessarily. Would we? Just kind of leveling off, stabilizing?
Yeah, I think it's probably pretty equal right now. Um, you know, it's still unattainable for a lot of people. It's expensive for the people that can't afford it. So it's not perfect in that way. But I just, after being in the business for a long time and watching a couple of these cycles now, nothing exactly like this, and nothing was exactly like the one before it. But in the long run, they always go up. And if we look at the average over the last 80, I mean, for a year that everything was supposed to be down, to have a national average of up 4%,
Mm-hmm.
that just means that we got really, we've been having too much appreciation at 15-20%, per year. And something needed to crack in this thing. And maybe it took the home loan rates going way up for that to happen, but it's actually, it's been a break that we've needed. But having a 4.6 average over the last 80 years just goes to show that maybe we're just in a little bit of a more of a normal market now. I mean, maybe it would have been nice to reset it a little bit, but getting into a house is just, however much time you take doing it is just time lost. And whether or not it's fair or the way it should be, houses will go up.
Mhm.
See, and
And
that's the thing we were talking about on the FHA, right, Christy? That it's better to just do it and get in.
Right, right. So, I mean, compared to if you look at it between now of getting in and maybe refinance a little later versus waiting it 6 months to a year, you're gonna be paying a higher price for the same home. So, and as we're seeing more new building going on and inventory increasing, it'll take some time, but being able to show and educate the client, this is what, based on that 4%, here's what you could be paying next year. So we could take advantage now, purchase, refinance later, put you in a better situation, maybe even get out of that FHA loan.
Mm-hmm, mm-hmm. And even if you don't refinance, you're
Mhm.
still getting the appreciation in your pocket.
Exactly.
So for people who are on the sidelines waiting to buy, what do you say to them about the cost of waiting?
I show them, we actually have a great chart to be able to show them, here's what you're paying in rent and what that's gonna look like for you. Versus here's if you purchase now, or what's it gonna cost you if you do wait. And how much equity you're building by purchasing versus paying somebody else's equity. And somebody else's rent with the payment going up, where you at least know what your payment's going to be.
Yeah, I don't know that people that are renting realize that you're buying somebody else a house. And the landlords, that's it's a great business. I'm, not putting anybody down, but you got to stop and think, if you're buying somebody else a house, why are you doing that? It needs to serve a purpose, because that money is gone, gone, gone.
Yeah, we were in a rental for 18 years when I was growing up, and we paid for that person's house probably three times over, maybe four times over.
Wow.
And yeah, I mean, looking back, it's just, it was one of the things that made me really believe in what I'm doing. After I got into this, I just went back and looked at what my family paid for rent, and walked away from it with basically nothing 18 years later, except, well, I guess we made a good life for the landlord, but
Sure.
Well, and that's the thing to keep reminding people that are renting it, and renting is fine. Just be conscious about it. But that's why, if you're waiting for something to go down even more, I just don't know it's going to happen in Southern Oregon, at least not in the next year or two.
I don't know how it would either, especially in light of the fact that we know rates are going to drop. They've already started, and it's going to be a frenzy again as these rates
Oh, yeah.
go down. It's going to be everybody just begging to get in and offer an extra $35,000 to get the
Mm-hmm.
house. So right now, while the sellers are a little bit more apt to work with you, I think it's a good time
I think so too.
to
Have you
talk about
seen
it.
some of the deals the buyers are getting? But it's legit. It's like, that is legitimately where the market is at. It's not like anybody is stealing a house. Um, but people are buying really nice houses under 450,000 in Southern Oregon.
And we've got a few into contract, especially in Grants Pass lately, but over
In
here,
the threes.
yes,
Mhm.
yeah.
Yeah.
And I mean, I know that sounds completely ridiculous, but like I always say, it sold at 147,000 when I bought my house. Hill. Everything seemed really expensive back then too. So,
Yeah.
and then we're never proponents of jumping in and doing something before it's time. We're not going to ever guide you that way, but to come in and have a conversation and go over some of these charts, because they're real numbers. They're not stuff we made up just to sell houses. They're they're what we've been dealing with forever. And I can't tell you how many people I've had come back to me 2 years later thinking that something was going to get better. And now it's, if they're not priced out of the market, they're at least well, they're having to buy something way higher than they would have had to if they had pulled the trigger back then. So just being educated, I think, is the best thing to have
Mhm.
happen. If we walk out of there, at least you know that now's not the right time, rather than wondering if it is.
And there's some clients that may not be ready yet, whether it's credit or having some funds set aside, but that's where we can be the advisors and help them put a plan together and make adjustments as life happens. And that way they're not losing sight of their goal of homeownership.
Well, and then they're doing it in an order that's meaningful to them getting from where they are to where they want to be in home ownership. That's so sometimes people don't want to come and talk
Mhm.
to you guys or to me because they don't feel like their ducks are in a row. Last couple of minutes, can you just give some advice about how important it is to talk even when you're unducked?
Absolutely, because I see it often, it's somebody's just inquiring because they're curious about it. And it's just, let's take a look, let's see where you are. If you're able to purchase, then we're gonna get you out and ready to go. If not, if we have a few things to work on, whether it's credit related or a savings goal or any of those things, then we're going to put that plan together for you and just help you right along. So we're not just going to sit there and say, oh, well, you need to do this, good luck, and let you walk out the door or hang up the phone. Let us help you. Let us be there as a guide. And because we do this every day. So yeah.
Yep. And you do know the shortcuts, and that makes the difference. It's also makes a difference to have a local lender. Can you speak to that briefly? We just have about a minute left in
Well,
this segment. There's more show.
Sure.
well, just one of them. I've seen examples on Zillow where they're thousands of dollars off on taxes even. I mean, they're only as good as whatever data
Right. Yeah.
from. So you got to figure that somebody that's not from around here is not going to understand a rate for a construction as far as where you're going to figure in those taxes when they can't even get the taxes right on the house that's already been assessed. And that could completely skew what somebody's looking at. And you're going to get the same thing a lot of times talking to that online lender that's just doing this after school in the evenings.
If you get the same person when you contact the online
That's
lender.
Oh,
that's
then there's
it.
that. Yeah.
We've just seen people with a lot of false hopes or the other way, thinking they can't buy because they got terrible advice
Oh,
online. And
yeah.
it is good to sit down because we have to be accountable. We live in this valley.
Yep. Yep. And that makes a big difference. We're talking to Christy Stockbrand and Guy Giles of Mutual Mortgage. We do have to take a quick break, but we're going to be back with more good tips from Guy and Christy. So do not go away. We'll be right back right after these messages. Well, hey, everybody, you're listening to the Real Estate Show with Guy Giles and Christy Stockbrand as our guest today from Mutual Mortgage. So, Christy, during the break, you mentioned that you had something you wanted to pass on that happened with one of your clients recently.
Yeah, absolutely. So I know we've been talking a lot about buyers in the show already, but for our clients out there who, already own their home and may have taken advantage of those extremely low rates that we have seen, nationally, credit card debt is at its all-time high right now. And so some people right now are struggling with payments, and a lot of phone calls that I get during the day is home equity options to consolidate some debt. So I did have a client recently where, he had a 2.375 rate, but had so many payments going out, he was paying about $3,500 a month in overall payments for everything. So I was able to take that information and show him, if we did the debt consolidation refinance, yes, his rate now is 7.125, but it saved him $1,200 a month.
That's amazing.
Oh, and it's just a matter of educating our clients and showing them the information and saying, this is what this can do. It's not always just about the interest rate, for sure.
Yeah, it's about the net result to your budget. Wow.
Absolutely.
So higher interest rate, paying off consumer debt through a refi, save them how much?
$1,200 a month,
Wow.
so over $14,000 a year.
Wow. That is huge. That is absolutely huge.
So we threw something up on the screen to show, where he would have been if he had just kept on making his payment. And then again, on the side, he's got all this credit card debt. He's got everything that he's paying on. But looking at it just as an overall kind of financial plan, him doing this, obviously, if he takes that $1,200 and just goes and spends it, yeah, his life's a little bit easier as far as that goes. But if he takes 300 of that $1,200 and uses that as extra money and takes 900 of it and applies it towards his principal,
Oh,
his loan,
wow.
yeah, his loan and everything is paid off in about 16 years. Oh, yeah,
Wow.
no, 14 years, pardon me.
Yeah.
And then he's debt free.
Mhm.
So he doesn't have
Wow.
anything, and he's still gained $300 a month.
By being willing to pay a higher interest rate and do something else with the money.
Well, and then if he took that $300 and let's say put it into a high yield savings account, he's then having an additional 30-some thousand dollars after, what was that, 5 years that we calculated it out?
Well, then he could buy
Or
another
14
house.
years?
He could have two houses.
Absolutely, absolutely.
Yeah, and yeah, if he was to actually invest that would turn into a over $100,000 that he would have in just kind of in a retirement account.
Right.
So, and we're going to put these charts up on the YouTube version of the broadcast. But for those of you listening right now, you'll get to see the appreciation and amortization chart that Guy and Christy put up. It's really amazing how fast that house got paid off. That's incredible. So the other thing is really good for you guys is that you're here, you're local. We talk about this sometimes. The online lenders don't really offer the same level of service, and my experience is they just don't vet the buyers as thoroughly until you're in the middle of escrow, which is really risky, boy.
I had a real life experience last month with a guy that was self-employed buyer. I knew that he hadn't filed his taxes in 3 years. And I said, you need to file your taxes. You're self-employed. We're going to have to look at this. And he sends me a screenshot like an hour later. Hey, thanks. I got something online and I'm approved already.
Oh,
And I
really?
told him, I said, that sounds like a pretty good deal. You should do that. And it did not take into account that his credit score was 630. It didn't take, I don't know what it took into account. Is all I know is at the bottom of it, I scrolled down and I read, this is all determined on us pulling your credit and looking at your income documents. And
Oh
I'm just like,
no,
what
they
did
didn't even do that.
he had a letter that said he was approved that he sent me.
That was almost like a little matrix approval thing that we used to do back in the day.
Yeah, it was
Wow.
it was pretty eye-opening as far as that goes. And I don't usually see things that bad, but what I do see is somebody that's only been taught to take data and to have just real surface conversations about if you refinance, this is what you could save, but not really a plan with that money after you do it. And if you don't have a plan on the refinance side of things, you're going to go right back and charge those credit cards up. You're going to, end up in worse shape than you were before. So, these are big decisions that people are making, and it shouldn't just be somebody online that is a one and done. We want to talk to these people's family members about their future loans. We want to talk to, everybody about these good experiences that people are having, and not somebody that's across the country that doesn't have a dog in the fight that you'll never talk to again after you do your little data entry. That's one of the concerns that I hear all the time for people that go online is I never got to talk to that person again. That person seemed like they knew what they were talking about. In reality, they didn't know anything about underwriting. They didn't know anything about the loan beyond how to sell it and how to take the information in. So once one thing goes wrong, you have a septic, you have tie downs on FHA. A lot of times these people don't even know how to deal with a shared well. So having somebody local that understands this, you're going to be a lot better off. And not to mention the fact that a lot of times they're not even right on how many months of escrows that we're going to collect in this state because they're from all over the country. So we see a lot of corrections there.
Well, and even for some of our first-time home buyers, they're not aware of the local programs or different grants and down payment assistance either, where we jump in and we know those programs and we'll search those out and utilize them if we can. Where the online lenders, they don't know. They're just very cookie cutter in a lot of cases.
Well, and it's so individual, and I think that's the part that people don't understand. It really is so unique to you and your personal, your personal finances and the kind of property you want to buy. And listening to you tell these stories, it just seems brutally unfair for these online lenders to be giving people false hope with a pre-approval letter that they're not entitled to. And then that unfairness gets kicked down to the seller. If they go and write an offer and the offer gets accepted, you've got a whole domino chain of people that are going to be disappointed in literally 4 days.
Right.
Well, yeah, and that's if you didn't pay for a home inspection or an appraisal or
Anything out of pocket that you don't get
anything
reimbursed
that you're
for.
doing. Plus, you put in your notice wherever you're.
Oh, right. Yeah.
So I mean, there's a lot of things that could fall, and the worst part of this whole thing is the rate that they had for this guy. I went in and I was able to price out on their website, and if you had the best credit score in the world, which this person did not, you weren't even close to that rate that they were offering. So I don't even know where that came from. And his
So
only
they were
fee was
dangling like a good rate online that wasn't fully
would
legit.
have never ever happened, not even for the person with the best credit in the world. And so I don't know how they sleep at night. Maybe they don't know enough to even know they're doing that to people.
Well, that's a good point. The online lenders themselves may not know. That's super interesting.
And sometimes they close and they're okay.
Right,
Don't get me
right.
wrong, blind squirrel every now and then, but
Well, I just think it's just grossly unfair to give a buyer a pre-approval letter if they aren't really supposed to have that.
Absolutely.
Yeah, get your hopes up. And then that makes the buyers not want to come in and talk to you when they really should come in and talk to you
Yes, yeah,
so that you could help them get ready.
exactly.
and when we get down to apples, 9 times out of 10, we're beating those guys anyway. Because they get people in, they get them all excited, they do that, then they pull. I don't know how they would pull the switch on this guy because it was so far off from what they were going to actually offer. But that said, when we get really down to really comparing these things, we're going to get beat sometimes, but most of the time we're not.
Yeah.
So that's kind of an interesting surprise that if you're going online to think you get a better deal, if you just looked at some people to help you locally, you might end up getting the better deal locally. And you get to close the house. You get to actually get the keys.
Well,
Right.
I've seen it where it looked $2,000, $3,000 cheaper with an online lender because they only quoted 1 month of escrows. And 11
Oh,
year. I mean, it could be something as simple as that.
well, that's interesting.
Yeah. Or you get they're advertising initially the interest rate, but then as we get through the process, surprise, rates change and you weren't locked in and here's what your new rate will be.
Well, and then we had a lot of that this last year, didn't we? So thanks, you guys. Can you hang tight? We want to get through our sponsors and then get back with more great information from Guy and Christy on the Real Estate Show. Don't go away. Well, hey, Southern Oregon, welcome back to the Real Estate Show. I'm Alice Lema. I'm a broker here in beautiful Southern Oregon with John L. Scott Real Estate. And we're talking to Guy Giles and Christy Stockbrand of Mutual Mortgage. Thanks again for being back on the show, you guys.
Good way to spend a Saturday.
And a Sunday. It repeats tomorrow at 8 a.m. So great information we've had in our little conversation today. Let's talk about some of the other success stories that you have.
Oh, sure. So It just happened to be another refinance situation, another debt consolidation. A client had been referred over to me because I was able to help a friend of hers. And we ran some numbers just to take a look at what a debt consolidation refinance would look like. And when I met with her and showed her the numbers, she never said a word. She just started crying.
Oh,
And
no.
I grabbed the box of tissues and I'm instantly wondering, what did I do? What's going on? Once she kind of had a couple minutes, she looked at me and said, I've been so worried about keeping my credit score up that I made sure every one of my debts were paid and I haven't had enough to have a ton of groceries so I can eat.
Oh,
And so that one was definitely heartbreaking. And, you know, I definitely knew at that point, seeing those numbers for her, how much of an impact it could make, you know.
wow. Wow.
We don't see those situations all the time, but it does happen.
But it's a good reminder, Christy, that it's not just what you're paying for your mortgage, because what you're talking about, these examples you're giving, are looking at the person's monthly budget
Right.
and using the house to readjust the monthly budget, right? That's what you guys are doing.
Absolutely. You know, and finding out what is their overall goal, and trying to help them in that path.
Mm-hmm. Well, it's really ironic that getting a new loan on your existing house, which is what a refinance is, at a higher interest rate than what you have, can still bring your monthly budget down. It's kind of counterintuitive.
Yep. So definitely utilize us as advisors, you know, let us run some numbers for you. It doesn't necessarily mean we have to, you know, have a credit report and everything. It's, you know, let's take a look, let's explore this and see what we can do.
We might even send you a totally different direction to get help.
Right.
I mean, it's not necessarily that this is going to be the answer for everything and for everybody, but we've been around long enough to where we do know the resources. So if something's happening and you or a family member, somebody's struggling, call your mortgage company, I mean, we would be a better overall advisor probably than just calling up whoever happens to be servicing your loan. But that said, just because we know all the local resources that we could send you to, if just doing that isn't necessarily the best idea, but hiding from it is never a good answer in the long run. It's just like cancer or anything. It's just going to get worse. You might be able to ignore it for a little while, but addressing it earlier, even though it might be uncomfortable, is the best way to go about it.
And that's why these radio shows are so important, because this education isn't really getting out there amongst just people who are not in the business. And this idea of going and getting a almost like a financial checkup with your mortgage person every few years, whether you need it or not,
Right.
because your life circumstances change.
I used to struggle. My insurance guy would call me up. Is all I could think about in the back of my mind is he just wants to figure out how to charge me more. In reality, it's good to go over this stuff every now and then and just take a look and make sure that you're doing things the right way. We all, take your car and get it aligned every now and then. It's kind of the same thing.
Exactly.
So this is a really interesting idea, and folks, we didn't talk about this ahead of time, so this is just coming fresh. But how often would you? And I know it's individual, but would you say like every 5 years, every 3 years? Because Southern Oregon market changes pretty fast. But if you're in the same house, how often should you come in and get like a little checkup?
At least once a year, you know, for myself, I'm, you know, looking at clients and, my database and seeing who's in there, and at least once a year,
So you're checking on them once a year.
Correct. Yes. Yes. And in some cases, you know, when we have interest rate environments where we may see it coming down quicker or increasing or any of those things, it might be every 6 months.
So it's the volatility. So you're adjusting to the opportunity or volatility.
Absolutely. Yeah, absolutely. You know, what is the market doing? And is there ways that we might be able to help our clients get into a better situation or prepare for whatever's coming in the market itself?
Mm-hmm. So go ahead.
Oh, I was just going to say, kind of I mean, and the answer might be do nothing. I mean, a lot of times that is the answer. And, you're not wasting our time to sit down with you for a little while to just kind of talk about it.
Right.
Um, and at least when you walk out that, hey, I've looked at this and I'm doing what the best thing is for me. And it's, kind of unlike all the science supposedly out there, math is math. Just knowing that you've gone through it
Mhm.
doesn't hurt, and it doesn't take us forever to do it. And we're not charging you. You're not racking
Yeah.
up a bill with us to take a little time to sit with you.
And it's
Right.
simple
That
as-
is so true because these conversations are free of charge.
Yes, absolutely. Just send us the mortgage statement and we'll run some numbers.
Oh, that's even easier.
Yeah.
That's even easier. And you know what else is like, as our lives ebb and flow through the years, our situations change. Like the folks that have kids, the kids grow up. These mini evaluations over the years could make homeowners aware of opportunities coming up that they don't necessarily walk around, having in their head.
College, weddings, I'm experiencing both of those right now.
Well, congratulations.
Thank you.
Gosh.
Um,
And
Well,
elderly people, if you have elderly people,
yeah,
and not all elderly people are really prepared for being elderly.
right.
and I'm not always a proponent of reverse mortgages, but with some of the elderly people, I had one come in here yesterday, believe it or not, at 78 years old, got divorced. And
Oh,
her ex-husband wanted her to get him off the equity line of credit that they had. And she has 18 miniature horses that cost a lot of money. And now she's on an income. She went down from $5,000 to $1,400 a month. And it's been really tight for her. And some people put a lot of money into a 401k and they draw from that when they get older. We met with her son. All the kids are on board. Everybody's on board with just letting mom enjoy her horses. And
oh,
this
that's good.
mortgage ended up enabling her to not have a payment other than her taxes and insurance for the rest of her life. She could stay in the house as long as she wants to at this point, and she's drawing down some of the equity in that house.
And that was a reverse mortgage?
Yes, yeah.
That's
And
awesome.
another piece is a lot of times people come up here from California and they say, I have $380,000. I don't want a mortgage. And then they can't find anything they like for that price. But we could do what's called a HECM or a purchase. And they could buy, a $500,000 house and still get exactly what they wanted, no payment for the rest of their life. Now they have a bigger asset appreciating for them. So it's
That's
not like
true.
they're going necessarily in the hole, and just paying cash without a reverse mathematically is going to be better. But if your kids are doing all right, everything's fine, why not?
Right.
And
Explore the option.
then you could be in the house that you want to be in. So yeah, it's just a matter of exploring it and taking a look at all the different options that we have.
Well, and again, that's why having a local person is so important. And you guys are really hyper aware of our markets. Even though you're not dealing with sellers directly, you're seeing the contracts, you're seeing the appraisals. You have a sense of what a house in Central Point is going to, appraise for. That your buyer's appraisals probably, you're not, doing real estate, but the online lenders don't have that advantage of just being immersed in our local economy.
Well, and going a little bit deeper with them with the original loan application, we'll say, Alice, here's these people now. Thank you for sending them over. They're ready to go. They might need $5,000 in closing costs, and that doesn't mean that they're going to get it. It doesn't mean that, anything, but we've had those conversations so you can go in making your offer and not getting surprised after it's accepted.
Mm-hmm. Mm-hmm. Well, we're going to have to wrap it up. We're going to say thank you to our sponsors, Giles Mutual Mortgage, John L. Scott, Ashland and Medford, and our local Rogue Valley Association of Realtors. We'd love to have you and Christy back on again in a couple of weeks. That'd be all right.
That sounds good.
Great. Thank you.
Great. Just a reminder, the episode will air again tomorrow, Sunday at 8 a.m. on our new Sports Talk Radio home. This is the ACE AM 1300. Joe Brett and Pete Belcastro are behind the scenes again. So thank you. Have a great Southern Oregon weekend. We'll see you next week.